We want to investigate why, when we have an income of, for example, $25 million, either we use flat tax rate of 35%, or we go through this model that for the first 50,000 we use 15%, and like that the answers are the same. Let's try it again with detailed calculation for $25 million and then see why it is happening. For the flat rate, 25 million, 35%, so it would be $8,750,000. And here, when we want to calculate the same income but under this model, for doing so, we calculate the number that how much 25 million is higher or is over than 18,300,000 and so. Because as you can see, we have calculated the previous one according to this model. So we want to do this last part of income according to this 35% to make it fair. So again, the same results. So let me tell you why it's happening. The reason is that the average tax rate for this part of the model tax structure is exactly 35%. Why? Okay, let me show you why. See, if you get the maximum income of this bracket, tax bracket, I mean, if you get that 18 million something, your tax would be this number that you can see here that we have calculated before, and you should have it also in your calculations. So it is the maximum tax that you get if your income is 18 million something. Exactly the upper bound of the tax bracket before this last part that now we are confused about. So it is the tax. Okay, if it is the tax that you are paying according to this model, what has been your income that you are paying this much tax? 18 million. $333,333. Correct? So what is the average tax? As you can see, it is 35%. So that's the reason. Either you use this model, you are paying 35% on this 18 million and something income you have, or if you use flat rate of 35%, because in both cases 35% applies to this 18 million and also this over 18 million. And if you use the other way, the model, I just showed you. Again, you are using 35%. So it is about weighted average, because the range, the amount, the money that is taxed according to 15% is very small amount, 50,000, or the 25% is just 25% in comparison to this part, that the amount of tax that you are the amount of revenue income that you are paying 38% income on is more than $3 million. So that's the reason. We have this example: land bought for $220,000, built for this, installation of equipment, and operation also begun on April 1. Yearly gross income $450,000, $100,000 in expenses, and this amount is the depreciation. Calculate the tax payable. Pay attention that this question is loaded with unnecessary information that you don't need to calculate the tax payable. And to do this, to calculate the tax, you need to use this table. The table in the previous slide. And so, again, pay attention that many of this data that is being provided to you are unnecessary for calculating the tax. Because I told you, for example, the amount of money that you have paid for building, it is not part of your expenses that you consider them. And this depreciation that you see here has considered all the depreciation in this problem. So I'm not gonna explain more to avoid spoiling this question for you. Stop the video and start working on it. Land bought for this, it has no impact on the tax. No impact on tax. I'm talking about direct tax, because when you build, of course, the depreciation of this building has impact on the tax. But this $900,000, we don't need it because we have already been given the depreciation. Equipment, we don't need it. Plant completed and operation begun on this unnecessary data. So you see, just it want to distract you. Remember that question we did for calculating the EUAC minimum. So here, yearly gross income, yes, we need it. It is the income, and the expenses are 100,000, and also depreciation 109,256. So the result of this tiny math that you see in front of you is the taxable income. And when you get the taxable income based on the number, you should go to the previous slide and see what is the taxable income that I'm gonna show you here. As you can see in this part, 450 minus 100 minus that 109. So the taxable income is 247.44. Okay, 240, it belongs to this tax bracket. and the tax would be 250. It is the lower bound from the upper bound of the previous tax bracket, plus 39% times how much it is over 100? 147 something. No, 140. 140, 744. So we go to this slide. Yes, that's correct. 140, 744. Here, as you can see, 140, exactly, you can see that numbers 250, 39% off that 100. So the tax that must be paid is this amount. In this example, I want to show you how tax impact something like internal rate of return. Here it says calculating after tax cash flows. Now you are familiar with that type of thing, and when it shows you ATCF, you shouldn't consider it as a new subject or topic. Everything is the same as before, just you add another element to your calculations. So let's do step-by-step calculations to understand this delicate change in a better way. So here we have a case. Initial cost is 15,000. Useful life 5 years. Forget about tax because here we want to do it in a regular situation. Okay, so we just have initial cost 15,000. The useful life is 5 years, and annual net saving, that is income, 4,000, and salvage value is 4,500. So please start working on this example and calculate the internal rate of return. Internal rate of return for this case. Why at this phase I'm asking you to do it without tax? Because I want to show you better the differences. So in this phase we are not gonna include any tax calculations. Stop the video and work on calculating IRR for this example. To calculate IRR, I'm using the function of rate and number of periods 5, PMT 4,000, initial investment 15,000, and salvage value, future value 4,500. 16.6% is the internal rate of return for this case. And here you see a tabular format for presenting the numbers that we have, year 0, and here we have IRR. Now let's do the same example, but this time we include tax rate, tax calculations. Okay, so for doing that, initial cost, you are going to use it, useful life 5 years, tax rate going to be 34% on the taxable income, annual net saving 4,000. It's an income, but it's gross. You need to deduct depreciation from that and salvage value. So since we want to calculate the tax, we need to calculate the depreciation, because depreciation is that type of cost that can help us in paying less tax. So what would be the depreciation? See, your machine now is 15,000. After 5 years, salvage value is 4,500. So it would be 10,500. Loss of value over 5 years. And please be advised, there are many ways to calculate the depreciation, and it is not the focus of our class. And I'm just showing you the easiest way to calculate depreciation, just to do an example. And also, this way of calculating, linear calculation, makes sense. Your machine 5 years ago was worth 15,000, and now after 5 years it is worth 4,500. So it has lost 10,500 due to depreciation. So depreciation over 5, it means that your annual depreciation is 2,100. Okay? So when they want to tax you, they are not gonna tax you on the gross income that you have, 4,000. No. They deduct the depreciation as well. So your cash flow for years, instead of 4,000, would be 4,000 minus 2,100. Okay? So I'm not gonna spoil the example because it's a very good practice for you. You need to create a table. In the table, you are gonna put income, you are gonna put depreciation, you are gonna put taxable income, and all those things. And after that, you come up with the net income. And finally, over that net income, please calculate the internal rate of return to see taxes cause internal rate of return to increase or decrease. So now stop the video and start working on this challenge. Do not worry if you get wrong answer. You are gonna repeat it, but the fact that you are doing hands-on practices and you constantly find out the parts you misunderstood or you need more practice, that's a great help in a good learning experience. I'm showing you that table that I told you about. So here, this column is the same as the previous one that I showed you. At year 0, 15,000 investment, and for 5 years income of 4,000, and also the salvage value. So here we have no problem. For depreciation, year 1 to year 5, 2,100 that we calculated. And now the taxable income, as I told you, they are not going to tax you on your before tax cash flow. They are not going to tax you on your gross income. So now the depreciation is 2,100, and taxable income is that gross income minus depreciation, as I showed you the formula before. So the taxable income is 1,900, as you can see. And that 34% applies to 1900, not 4000, because again, that absolutely they need to deduct depreciation before everything to apply that 34%. So 34% of this 1900, we get them, and now you are allowed to deduct this tax from your gross income to get to that net income you have. So now the cash flow you have 15,000 is the same. It is the initial investment, and after that, for 1, 2, 3, 4, 5 years, you are having that, because now you have deducted tax. To understand it better, just go and check your paychecks, the bill, the receipts that you receive from the employer, and see. Always it is deducted, but how it is calculated and how under what rules, it is the general logic in a corporate that I'm showing you. So now another thing that I have for you, it is the cash flow after tax that you are seeing. For the initial investment, there is no difference between before tax and after tax. For the salvage value, there is no difference, but for the income, absolutely there is difference, as we all have experienced it when we are getting our paycheck. So now you have this number, go and calculate the rate, and now we can compare the impact of 34% tax rate. I changed this to the new one, 3354, and internal rate of return now is 11.2%. That is way lower than the previous one, and as you can see, here is the answer. So now it is for a while that we are not learning a new capital budgeting formula or function. We are just using everything we have learned from the beginning of this course in different situations, and now we just see when we want to use all those formula or these things that we learned together for after tax cash flow, that maybe before this seminar you thought that it would be complicated and many nuances and many points. No, it is just calculate the tax and deduct it. Now the calculation of tax is, and how to calculate it, because when we have the number, it's very easy, and now we know also the general rules that how all the things are connected, and those details about, for example, calculating tax, it is not our field of expertise. Do not worry about that. You should be good as a financial manager, understanding all these things. And I hope now you are more confident regarding any table of numbers or financial statements that you see, in terms of reading them, understanding them, and analyzing them. Another example, I know it is easy for you and it's just a piece of cake for you, but let's do a simple example at the end so we finish this session like a champion. Go ahead with that. The firm before tax cash flow is 800, depreciation is 450. What is the taxable income? And the tax rate is 34%. It is before tax 800, and it is telling you depreciation, and we talked about the fact that depreciation should be deducted from the gross income to calculate the tax. Okay, stop the video and do the math. Okay, the taxable income would be 80 minus 450. So the result would be 350. Now we have these two. Absolutely not. And after that, times 34. So the answer would be option C. If I ask you what is the cash flow, what would you say? You would say 80 minus 119, correct? Because now it is the tax that you are paying. Tax minus growth income give you the cash flow after tax.